And I think that there's just a lot of people who hold Bitcoin who say, look, I like it at $60,000+, and the geopolitical uncertainty and chaos actually makes me want to own more Bitcoin rather than less, because this thing is neutral and isn't subject to any one country.
Pompliano begins by highlighting a striking observation. During the Iran conflict and broader geopolitical instability, Bitcoin has held steady, flat to slightly up, while traditional assets have declined. This is important. For years, critics labeled Bitcoin as a high beta risk asset, meaning it should fall harder than stocks during downturns. But what we're seeing now challenges that assumption. When stocks drop, bonds weaken, and even gold fails to rally, Bitcoin's resilience raises a critical question. Is Bitcoin evolving into a neutral global hedge? Pompliano doesn't claim victory just yet. He acknowledges that over the past year, Bitcoin has underperformed relative to other assets at times. But this moment, this divergence, signals something deeper. Investors are beginning to rethink what Bitcoin actually is. Rather than behaving like a speculative tech stock, Bitcoin is increasingly viewed as a geopolitically neutral asset, one that isn't tied to any government, central bank, or national economy. And in times of uncertainty, neutrality becomes incredibly valuable.
Bitcoin's been the shining light over the Iran conflict. I mean, stocks are down. You see bonds going down. You see gold going down. Bitcoin has been flat to slightly up. And I don't know if you can take a victory lap in the sense of over the last year, it's been the opposite. Bitcoin's been down and those assets have been up. But I do think that people are saying to themselves, well, I thought that Bitcoin was supposed to just be kind of beta to the rest of these risk assets. And so if everything else is selling off, why is Bitcoin not selling off? And so I do think that there's a little bit of light at the end of the tunnel for Bitcoin investors who have been taking a couple of beats. I think that volatility has significantly compressed in Bitcoin. It was, an 80, 90 vol asset. Now it's like a 40 vol asset. It drew down 50%. That's kind of what you would expect in that kind of volatility environment. And I think that there's just a lot of people who hold Bitcoin who say, look, I like it at $60,000+, and the geopolitical uncertainty and chaos actually makes me want to own more Bitcoin rather than less, because this thing is neutral and isn't subject to any one country. I think it's a little bit of everything, right? One of the things that people have long talked about with Bitcoin is how do we get mass adoption? That was the kind of the phrase everyone used, and this is what mass adoption looks like. Is you have individuals, you have companies, you have ETFs, you have. I think if you look at gold as a good example, people used to talk about $5,000 gold price, and it was at $1,800, and everyone kind of thought it sounded crazy, right? It will get there. I think Bitcoin is a very similar thing. What the time frame is very, very hard to nail down. But what I will say is just look at the compound annual growth rate. If the stock market compounds at 8 to 10% a year, Bitcoin should do something that is multiples. There's two things that have happened. One is I think that there are a lot of countries who are saying, hey, how do I participate in this without explicitly going and buying Bitcoin itself? And so you see them doing things like JVs on the mining side and stuff like that, especially the Gulf countries. But also you've seen a number of disclosures where country sovereign wealth funds have gone and taken positions in the ETF. And so I don't think it's, kind of this like chaotic, enthusiastic, hand over fist buying of Bitcoin that people thought they were going to do in their central bank. But I do think that there has been, allocations that we didn't have just 2 years ago. And that, it's kind of like a slowly and then all of a sudden. And I think that's probably what we'll see here. So for the last decade, I've been coming on here, pounding the table about Bitcoin. It's been one of the best performing assets. I'm coming back to pound the table and tell people that there's a supersonic tsunami of artificial intelligence that is coming to finance. And I think that people are drastically underestimating how quickly things are going to be built, how pervasive the impact on jobs are going to be. And we want to be a pioneer of doing that. We've got a public company that we see as an agentic finance firm. The first product we have is a consumer finance product that basically allows anyone to upload all of your financial accounts, and you can start talking to an LLM with personalized insights for you. We now are taking a step forward. Today, we're launching an agentic research offering. And what that basically means is we are using AI to not only go and do the research, right? AI is very good at sorting through all this data to find hidden insights in financial markets, but the AI is actually creating the reports and going and actually getting it published as well. And so if you think about this, we could publish hundreds of research reports per day. Right. We have one human who's overseeing this entire AI system. And I think that people are drastically underestimating how smart the AI is, but also we can just produce this stuff now cheaper and faster than the humans can at other research. So there's two things that are important. So first is on our consumer finance product, we've built a lot of proprietary AI agents. We've started to train our own models and do a number of things that are very proprietary and specific for that use case. We'll start doing the same thing on the research side. The second piece of this, though, is there's no monopoly on good ideas. And so no different than a researcher who sits around a table and says, hey, I wonder if the correlation between where the CEO went to school and the stock market performance, let me go do that research, right? You still have to come up with what these things are. And so what we think is really interesting is actually having the AI go and try to figure that out and try to understand where are the things that are most interesting, where are the kind of the hidden insights. And if you go and you look, some of the research that we published this morning at procapinsights.com, you can go and see there's things that no one's talking about yet. For example, what are the 3 companies that are supposed to benefit from both the Iran oil shock and the tariff refunds? Right now, you start to get into this complexity where instead of taking a single narrative, you start to actually try to stack these things on top of each other and look for overlaps. That's just one example of where AI is really, really good.
Pompliano introduces the concept of agentic finance, a system where AI agents don't just assist but actively operate within financial markets. These agents can conduct research, generate investment ideas, execute strategies, continuously learn and adapt. This represents a fundamental shift from human-driven finance to AI-augmented and eventually AI-driven systems. However, Pompliano makes an important point. Even with powerful AI, ideas still matter. There is no monopoly on creativity. Whether human or machine, the ability to ask the right questions remains critical.
Now, a few weeks ago, and by a few weeks, I guess I mean almost a couple of months ago, we put out this video, right? And what it said was stocks to drop 10% soon. And you can see that the price was at around 6,900. It was the same week we had put in an all-time high. This was the week of the last week of January, early weeks of February. So we said that the market will likely drop 10% soon. And I want to talk about what happens next. Right now, the stock market has already dropped about 8.5%, almost 9%. Maybe by the time you watch this video, it will have already dropped 10%. But I want to talk about what I think is going to happen in the short term, maybe show some of the longer term views, but let's first talk about the short term implications of what is actually happening. What I expect to happen is I think the market will likely form a low sometime in April before developing into a counter trend rally. We went through this same process with Bitcoin. It's just that Bitcoin did it sooner. And essentially what happened is Bitcoin broke down. It then eventually back tested the bull market support band, and then it went down even more. Okay. Now, while the S&P 500 has wicked back to the bull market support band, it hasn't really had a durable counter trend rally. I think you will likely see the stock market drop a little bit more. I think it'll probably drop a little bit more than 10% before then likely bouncing back up and potentially back testing that bull market support band. Now, here's the tricky thing. While I think what makes the most amount of sense would be for the stock market to drop into early April and then back test the bull market support band and then go down, there's chances that it plays out differently than that, right? There's a chance that maybe we just go ahead and get a 20% drop now, but there's also a chance that you actually see this come back up and sweep the highs before coming back down. The reason why I think it makes sense right now to suggest that the stock market will remain bearish into the first half of April. From there, I think a counter trend rally is likely to develop, and then we can talk about the strength of that counter trend rally once it's underway. That is where I am right now on this. I want to give you guys a couple of things to look at. One of the things is why have I been bearish? Why did I put out a video in February saying that the stock market would even get this drop to begin with? Well, that's a good question. And the main answer is if you look at the stock market against gold, you can see that in fact the stock market was breaking down against gold back in February. And the recent counter trend rally that we saw over in Bitcoin and some of the weakness over in gold, all it did was allow the stock market to backtest where it broke down from against gold. It did similar stuff back in 2008. If you go back even further, you'll see this is the same valuation that the stock market broke down against gold back in 1973. So what I think is the most likely outcome is to watch for the stock market to extend its losses against gold and then perhaps get a counter trend rally against gold before going even lower. Okay. Now, the reason why the timing, or it's so difficult to know how high the counter trend rally will go is because there's so many different examples where it plays out in completely different ways. If you look at 2022, we went down and we just had counter trend rallies back up to the bull market support band and then went lower as the year went on. You can see that pretty clearly. In 2018, when we had the same administration in the United States, what you'll notice is that the stock market put in a high in the early part of the year, just like it did over here. It then had a correction where it dropped about 12%, but it ultimately found this low right here in the month of April, about 12% down, rallied to all-time highs, and then had a bigger drop going into late 2018. So it's not impossible for things like that to happen. The other thing to remember is the stock market divided by the money supply. This is this is a longer-term bearish chart, but it would be a shorter-term bullish chart if this continues to play out. And I'm sure you guys are aware of what I'm going to say because I've said it 1,000 times. I truly, truly hope this fractal breaks because if it doesn't, it wouldn't be a good thing. But if you overlay this, what happened in 1996 through the dot-com era, you can see everything still kind of lines up, right? You had the correction we had back in late 2023 with rising yields, corresponded to the correction we had back in 1996, 1997. And then the 20% drop we had in 98 corresponds to the tariff drop in 2025. And then the current drop right here corresponds to a drop we also had back in 1999 before going back up, sweeping the highs, and then everything came crashing back down. So in that case, back then when the market dropped, if this is where we are, we just had that top. And that top ended up being about a 14 to 15% drop before rallying back up. It swept the highs and then eventually came down. So what I would say is this. It's so hard to know how this is going to fully develop over the next few years. There's always a chance that the business cycle just ends this year and maybe the stock market rallies to the 21-week EMA in say May, and then we get sell in May and go away, we get a big drop, and then we sort of reset the business cycle and all is fine. If, on the other hand, we drop and then bounce back up and then kind of sweep the highs, you could get a more protracted drawdown later on as the unemployment rate potentially starts to creep up in future years. Now, I don't want that outcome to happen. I would prefer that the next counter trend rally yields a lower high. But as someone who's been in the markets for a while, I know it's not impossible for the stock market to sweep prior all-time highs when in fact you are near the end of a business cycle. You could already argue we swept this first high right there, kind of like what happened in 2021 going into 2022. But I do not want to sort of deny how things played out in 2018. And I don't really want to deny how it played out in 2000 and also 2008, where you had in 2007, 2008, which you'll remember is that the stock market set a high and then it dropped about 12%, rallied back up, swept the high, and then sold off into the financial crisis. So I want people to be aware that when the next low is likely formed, and my guess is in April, it's going to be difficult to know the strength of that rally, but I would think that a rally will likely materialize sometime around then, just so that it keeps people guessing, right? Whether it goes back up to the bull market support band and then drops, or whether it goes back up, sweeps the high, and then drops. That's difficult to know, but I think where I would say is that the market will likely drop again after the current low is in, regardless of whether we sweep the highs. Those are my views. If you followed along, it's not easy putting out videos calling for 10% drops in the stock market because timing the stock market is very, very difficult. But we put this out the week the market topped. And since then, the market is now down almost 9% from those highs. So we're nearly at that 10% drop. I could see it extending a little bit further, maybe like 10 to 15%. Then you form that counter trend rally. And then once the counter trend rally starts, we'll then talk about what are some realistic expectations, what's going on, and then try to sort of finish up this business cycle as quickly as we can. I hope it does not drag out for 2 or 3 more years. I hope it just ends. But we have to work with what we have. And I don't control the markets. You don't control the markets. None of us have a crystal ball. We're all just doing the best we can. I'll try to show you what I think's happening along the way. And at times I'll try to talk about the path. But I'm only going to talk about the path when I actually have some conviction on it. There are times where I don't know, right? And that's okay to admit that I don't know sometimes where the market's going to go because it's really difficult. But I will say that an April low seems about right. Couple of reasons. One is the low we had in 2025 was also in April, right? So April 2025, why not April 2026 for a low to be set? And then going back to the .com comparison, we had the first low we had in October of 98. That corresponds to your tariff crash last year. And guess what? That next low that we had was October of 99. Exactly 1 year later. So I'm looking for the stock market to form a low again sometime in April of 2026. Look for a rally after that, and then we'll talk about whether that can lead to a lower high or a higher high. Remember, if it goes to a higher high, I think it'll only be a sweep. It likely will not be anything sustained. And the components of the S&P that are allowing that all-time high are probably different than the components that allowed the all-time high back in December. You'll see rotations between sectors, more defensive positioning that allows the S&P to go up rather than expecting for a lot of the tech stocks to all make new all-time highs. You could see rotations within that could allow the market to then get that counter trend rally back up to the upside. But in general, when you think about the stock market against gold, after it broke down in 1973 and in 2008, there were no all-time highs after that. So I don't want you to marry the S&P M2 valuation. I much prefer the S&P gold valuation. And with the S&P gold valuation, there were no all-time highs after it broke down, right? You can see it right here. Look at 73, no highs after it broke down. And of course, in 2008, no highs after it broke down. So I would say look for a lower high, but don't commit to it a ton. I would say look for a lower high, but be open-minded for a sweep of the prior high. And if you can do that, then I think you can at least be positioned correctly for how the rest of this bear market will play out.
Navigating the stock market is never about certainty. It's about probability, adaptability, and discipline. What we are witnessing now is a market in transition, from strength to weakness, from optimism to caution. The initial call for a 10% correction has largely played out, but that was only the beginning of the story. The next phase, likely involving a short-term bottom in April, followed by a counter-trend rally, will be critical in shaping the broader trajectory of the market. Will the rally lead to a lower high, confirming a bearish trend? Or will it deceive participants with a final push to new highs before a deeper? The truth is, no one knows for sure. What matters is staying informed, remaining flexible, and understanding that markets are complex systems influenced by countless variables. Even the most experienced analysts acknowledge uncertainty, and that humility is what ultimately leads to better decision-making. As we move forward, keep a close eye on price action, intermarket relationships, and macroeconomic signals. The coming months could define not just the next trade, but the next chapter of the entire market cycle.